Welcome back. We're still talking about the AMCON management shake-up, and I've been having a conversation with the Managing Director, CEO of Financial Derivatives Company Limited, Mr. Bismarck Rwani. Mr. Rwani is still here with me in the studio. Thank you so much for sticking around as we coast into home stretch on the program. So we were talking about the foundations that were laid for the banking sector post-intervention from 2009 to now. And just before we went on that quick break, I asked, are there any, or is there any unfinished business in the banking sector post-August 14, 2009?
Yes, I think, first of all, sanitizing the banking system because of the crisis that emerged was done. Laying the structural and strategic base for a competitive industry going on forward was unfinished, in the sense that the central bank deferred the adjustment of the currency for too long and maintained an artificial exchange rate and supported it with high interest rates, going from 6 to 13%, 12% per annum MPR, and then to 13%, was too aggressive, instead of adjusting the currency downwards. So what has happened now is that you have a liquidity crunch. You just showed some numbers there that showed that overnight rates were 36%, while the average yield on treasury bills is 15%. Nobody takes money at 36% and lends it at 15%. Why? This is an unnatural situation. The CRR at 31, that means 31%. If you take a deposit of 100 naira to a bank, the bank has to take 31 naira and give it to the central bank at 0 rate of interest. That is killing to the banking system. The CRR has to come down. So all of these administrative measures meant to keep the currency at that value is not going to last for too long. There'll be a need to make some significant adjustments after the central bank is fully aware of the fiscal policy of the federal government. That is the real issue. And so right now we are responding to fires that have been put out by low oil prices, speculators and all of that. We have to go back to a fundamental approach to dealing with the currency issue. That the central bank cannot do until after the fiscal policy is established by the by the executive of President Buhari.
Like you constantly mentioned, we have a crisis issue almost brewing on our hands.
Yes.
We have oil prices coming down rather rapidly as well. We have currency issues as well. And then we've got other macroeconomic headwinds that we're having to deal with.
Yep.
And then we still have to ask this question. The conditions that led to that August 14 intervention, are they likely to come up again?
Yes. Like I told you, one is currency adjustment leads to financial adjustment, which leads to bad assets in the system. Our capacity to withstand those shocks is seriously eroded because our buffers, in 2008, we had external reserves about $53 billion. We had excess crude account of $22 billion. We had enough fat to withstand the shock. Now we are pretty lean on the ground. So we don't have the capacity to withstand massive shocks at this time. However, the shocks that we are going to face at this time are going to be much less than the shocks that we had in 2008. And that's the good news. And the fact that the banks have been well capitalized all this time and therefore unlikely to stumble like they stumbled in 2008, that does not take away from the fact that these banks and the banking system are still going to face some serious issues. You just talked about aviation, power sector, oil acquisition, oil blocks and all that, which were predicated on a price of $90 a barrel. Now, those oil block purchases at $46 a barrel are underwater transactions immediately. So what are we going to do? We have to take a deep breath, no panic, and allow ourselves to work out, restructure some of these facilities over a longer period. There will be intervention by the federal government. There will be intervention by the agencies to stimulate the economy. Just like you have state governments that cannot pay salaries, right? There was some intervention to bail them out, right? But the thing about bailouts is that one bailout leads to another bailout and another bailout until things stabilize. So fundamentally, there is a crisis, not just in Nigeria, across all commodity-producing countries. And each of them are taking some serious adjustments. Yesterday, Angola increased. We saw inflation in Angola go up to 10.5%. They've taken away subsidies. Ghana has taken away subsidies. Dubai has taken away subsidies. They're selling petrol at 75 cents a liter, right? We are selling it at 48 cents a liter right here. So there are many things that have to come together to bring about a stable equilibrium in the economy.
And until then, it just seems as if the banks keep on hitting their heads against the wall, because they're trying to come up with whatever it is that they can to ensure that they stay afloat. They, protect customers' monies without going under, because we had issues of some of those banks. We had like 3 nationalized banks that came up at the end of the day, and none of these ones want to fall into that category. And
no,
so
they won't fall into that category.
They're battling with, keeping their top and bottom line above water, and
no, I tell
it's
you something.
really stifling.
I tell you something. We have no choice but to reduce the CRR. If you reduce the CRR, that is the compulsory cash reserve ratio. If you take it down from 31, say, to 20%, it will release much more liquidity into the system, because the Treasury single account itself is going to take over £1 trillion out of the system again.
Now you have that they're also contending with.
So you must give them something back, else this is going to be strangulating.
Yeah, because we saw interbank rates, like you already pointed out, interbank rates coming in lower yesterday,
yes,
because of the amount of money that exits the system, and that happens on a regular basis.
Yeah, you're going to be oscillating from a little breather to strangulation, a little breather to congestion. That's not fair, and that's not safe. What we have to take a fundamental view: take the CRR down, allow the currency adjust a little bit, take away the subsidies, and then the economy will come back into equilibrium. It is not just Nigeria. Every country in the world is doing it. So I don't know why Nigeria is so scared to just take the bull by the horns.
And so that's the concern that everybody has, because bank financials may record increased bad debts, by the end of the financial year. So should this new management team be concerned that they'll have a lot of work to do before or by that time, by the end of the year?
No, the team knows what to do. It's whether they have the resources to do it. The resources have to come from 2 sources. 1, Federal Ministry of Finance. 2, Central Bank of Nigeria. The Central Bank balance sheet as a percentage of GDP in Nigeria is slightly higher than normal. So the Central Bank is not going to be throwing money all over the place, and rightfully so. The Federal Ministry of Finance has FAC and all the other things to care about. And so we go back to the basic: what are the 3 pillars of this administration? 1, fighting insurgency. 2, fighting corruption. And 3, dealing with unemployment and stimulating the economy. All of these things will happen at the same time, and there will be some financial turbulence. The capacity to manage this turbulence is there. The will and determination to manage it is there, but they need time to settle down.
But there's no time.
There
really isn't any time, because you see, he's hit the ground running, and he just has to begin to deliver, because everybody's eye, including your eyes, Mr. Ruwani, is going to be on the team.
Absolutely. So, and they say you go to war with the army you have. You don't go to war with the army you wish to have. The war has started already.
Oh, well. We'll have that in mind. Well, thank you so much for coming on the program this morning and sharing your perspectives with us.
Thank you.
That's the program for today. Many thanks for spending time with us. I'm Harriet Agbenyi. Have a profitable day.